Podcast with our host, Ed Lyon. Ed, it's time to talk more taxes, but in a different way of taxes, how taxes really relate to healthcare, which a lot of people don't think about.
Yeah, so taxes drive so much behavior in America, and healthcare is one area where taxes drive behavior. And it's surprising to a lot of people, but the whole healthcare system is built around tax law. So our guest today is Anthony McMahon from ClaimLinx. Anthony, if you want to tell us a little bit about yourself. And people watching are going to wonder why you're on this call. And we'll explain why you're a part of the tax system too.
Yeah, absolutely. I think we think similar. All we're trying to do at the end of the day is save business owners and their employees as much money as possible on this insanely expensive thing that we call health insurance here in America. We utilize the tax system to the employers and the employees' advantage. We buy it in a more, I would say, efficient way. And we get paid based on how much they save, which is a complete opposite model of the entire industry where brokers, agents, whoever get paid in relation to the amount of premium that the employers are paying to those insurance carriers. We want to align our incentives, save the money, and just do it a smarter, more efficient way and take advantage of the tax part of it as well.
Sure. So let's take a step back and talk about why taxes are such an important part of healthcare and health insurance in the country. And it goes back to World War II, when we were in the middle of defeating the evil hordes. The government put wage and price controls on what businesses could charge for products and services and what businesses could pay for their employees. But businesses still needed to compete for employees. So they took advantage of a section of the tax code that let them offer employees health care coverage at no cost to the employees. It would be deductible to the employer and not taxable to the employee. So businesses that wanted to increase hiring would start paying employees in the form of wages plus health care benefits. And that goes all the way back to the 1940s. That's stuck in the tax code ever since. There are very few countries in the world that tie health insurance to employment. Most developed countries have some form of universal health care, some form of what a lot of people in the United States call Medicare for all. But it's a tremendously important influence. If I'm an employer and I can give you wages, which are subject to income tax, FICA tax, unemployment tax, or I can give you health care benefits, which are deductible to me, but not taxable to you, I'm going to want to shift how I pay you so that you come out ahead, an employee. And we have this system in the country where big enough employers like General Motors just pay for their employees' healthcare costs out of pocket. Those are called self-funded, self-insured employers. Other employers know that if they want to compete for employees, they've got to offer benefits. Most of them do that by going to an insurance company and buying an insurance policy. And maybe the employee pays for some of that insurance. Maybe they pay for a lot of that insurance, but it's driven by the tax code. Now, that's great in theory. Problem is, healthcare in this country has gotten so expensive. Anthony, I'm sure you have a better sense of average healthcare costs, but you were telling me last week you've seen families that are paying, you've seen coverage that costs $5,000 a month for a family.
Yeah, I've seen as high as about $5,300 a month family premium. Yep.
That's insane.
Yeah.
That's the headline from this conversation, is that health insurance can cost up to $5,300 per family per month. Now, Neil and I, we live in Ohio. $5,300 a month buys you a really nice house in Ohio.
Yes.
I've never had a mortgage more than $5,300 in my life. Maybe that doesn't get you very far in California or New York, but that's insane. So businesses are in pain The same way that my tax clients are in pain over their tax bill, business owners are in pain over the bill that they have to pay for employee benefits to take care of those employees. What you guys have done at ClaimLinx is you've come up with a different approach. Neil, you and I have talked before about how the average accountant tells you how much you owe. I tell people how to pay less. Well, the average health insurance agent tells their business owner clients, here's how much you're going to have to pay for coverage next year. And if your cost goes up, you can talk with your employee about sharing more of the burden. But it's a conversation about here's what it costs, and now you're fighting over the cost. What ClaimLinx does that is so analogous to what I do in taxes is ClaimLinx doesn't just say here's how much it costs. ClaimLinx says here's how to pay less. Here's how to buy the same amount of benefit for your client for less money. And that benefit will include probably some form of insurance. It may include a self-funded plan, a medical expense reimbursement plan. And we're not just going to buy a commercial policy from United Healthcare or Anthem and pay what it costs. We're going to look at different strategies. So, Anthony, if you want to tell us a little bit about that fundamental approach, dig in a little deeper about how you turn what you owe into how to pay less.
Yeah, I think the easiest way is just to contrast the different approaches. 99.99% of businesses and brokers, basically, they take a census, they send it to the broker, sends it into the carriers that they're appointed with. Say they're appointed with 5 carriers, they'll then present those options to the business owner, and basically you choose the best amongst the worst. There's no creativity in it. It's just, hey, here's your group, here's the census, here's the rates that we were able to get out. I liken them to a conduit. They're just thinking eventually, I would think it would become AI. We'll see.
Because the agent's not really adding any value that AI can't create.
Yeah. So, all they're doing is they're taking an Excel doc, putting in their email, sending it over to the underwriters of the various insurance carriers. That's all they do. Then they show the options, they pick, they renew. Same thing at renewal. They're like, oh, you got a 20% rate increase. Let me see what I can do. And they'll knock it down to 15, 12, 10. And I think they're a hero, but the perverse part.
Then they're like Indiana University with the national championship trophy, thinking I'm a hero. I did this wonderful thing for you. I took your 20% rate increase and I turned it into a 15% rate increase.
Yeah, but the problem is they're already overpaying by 40% more than likely. It's just, it doesn't make any sense. Plus, every year they get a rate increase, they're getting a raise. The broker's getting a raise, the agent's getting a raise because they're getting paid a percentage of the premium. Premium goes up, they get paid more. Client gets a worse outcome, they get paid more. It just doesn't really make any sense to me. I don't know how it got to this point, but that's what we're competing against. And
yeah, certainly the incentives for the broker are very, very different than the incentives for the client.
Yeah, exactly. So contrasting that to what we do, we obviously generate a census, but we do it in a smarter way. So we'll have the employees fill out health apps so that I can't see them, but our agency team, they take a look at it and they try to say, all right, for this group in particular, for these set of employees with their families and their issues and where they live and what they're dealing with and even like income levels, et cetera, how can we best present this group to the insurance carrier to get the rates as low as possible? And the reason we do that is because we're incentivized based on savings. We get paid a percentage of the savings that we're able to generate. Get a good outcome, we get paid, as opposed to get a worse outcome, you get paid more like a broker or an agent. Yeah. We assess the group. Every group's different. We tailor the approach based on the company. We send it into the carriers to try to get the rates as cheap as possible. Basically, how we do that is a very simple 2-step process. At the very basic level, get the highest deductible, lowest cost plan that has the network of hospitals and doctors that employee base needs. Typically, that's a national PPO network. If they are fine with an HMO or an EPO, that's cool as well. But most groups want to have a PPO, so there's a lot of flexibility and everybody's within network. So basically buy the highest deductible, lowest cost option with that PPO. Typically, you're going to reduce the rates by 40 to 60%, obviously, depending upon where you started. And so once you do that,
you're buying less coverage.
Yeah, you're buying less coverage, but you're maintaining the 2 most important things. Stop loss, granted it's at a higher threshold, and you're maintaining the hospitals and doctors that they need to see so they can get the care that they need when they need it. but you're going to pay, call it roughly 50% of the amount of fixed cost. And then once that is in place, you can call it a shell if you want.
Okay.
You then implement a secondary MERP, medical expense reimbursement plan, which I'm sure you can dive into even further. And any details that I might not be sharing here might be helpful from the tax side. But
let me interrupt you there and go into a little more detail. As I said at the beginning of the show, bigger employers don't need to buy insurance. Insurance is a tool for spreading the risk because you don't know who's going to get a cancer, who's going to have a premature birth, who's going to have some rare genetic disease that even Dr. House couldn't diagnose. So the larger the pool is, the easier it is to spread that risk among the pool. Now, if you're a company with 10 employees, you don't really have a whole lot of employees to spread around that risk. So you're going to take that risk to an insurance company, and part of what you're buying from the insurance company is protection against the risk. Now, if you're a bigger company, if you're a 3,000 employee company or a 30,000 employee company, the law of large numbers takes over. You don't need to lay off the risk within an insurance company. You can have that risk yourself. Maybe you'll buy a stop loss policy at $50,000 per employee or $100,000 per employee. So if you're a big enough employer, you don't have an insurance company. General Motors is the biggest private health insurance pool in the country. At least they were at one point. I think they still are. They don't buy insurance. They simply take advantage of a section 105B in the tax code that says when General Motors pays medical benefits to its employees, they're deductible to General Motors and they're not taxable to the employee. So that is a medical expense reimbursement plan. But what you're talking about is when a smaller company or even an individual sets up a plan for themselves and says, okay, we're going to buy insurance. We're not going to buy Cadillac insurance. We're going to buy Yugo insurance. You'll have the network that you want and you'll have the stop loss. But then we're going to supplement that insurance with our own plan. So maybe a company had a $2,000 deductible and now they're buying a $16,000 deductible. They cut the cost by 50%, but the employee's left out in the cold now for the difference between the $2,000 old deductible and the $16,000 new deductible. How do you restore the benefit to the employee? You just finance it out of your own pocket. You take some risk, but the risk is capped at the deductible. And now you're not paying the insurance company to take on that risk. You're not paying the insurance company to administer the claims. You're not paying the insurance company to do all the bloated things that the insurance company does. And really, you're cutting out the middleman. That's basically what you're doing. And the middleman never likes to be cut out. So insurance companies will sometimes object when they're cut out in that manner. But it is a perfectly legal strategy under the tax code. The tax code encourages it. The Department of Labor allows it. So that's the first step in a two-step razzle-dazzle. So we're going to raise the deductible, we're going to buy less coverage, and we're going to restore the difference to the employees out of our own pocket. And ClaimLinx then will administer that plan. And tell me a little bit about how ClaimLinx does that.
Yeah. So basically, you covered most of it, but essentially, higher deductible, maintain the network, maintain the stop loss. Typically on year one, the business just literally copies and pastes the same benefits that they had if it was satisfactory to the employees. Say they had that $2,000 deductible plan before and whatever the copays were, $20 office visit, $50 specialist, whatever. We'll literally just copy that in a new secondary schedule of benefits that's paired with the MERP, and then that becomes the new day-to-day benefits for the employees. So nothing changes from their end. They still have the same deductible, out-of-pocket maximum, copays, visitation limits, et cetera, because we literally copied it from the previous plan. And now the only difference is the company is going to give back a portion of that 50% fixed premium cost savings that they're generating by paying the claim difference between what the employee owes versus when that out-of-pocket maximum kicks in. Say it's a $2,000 deductible for a single and we switch them over to a 7, the employer is picking up that $5,000 gap only if and when it's actually used. And yeah, go.
So it's a cash flow consideration for the employer. You're not pre-funding accounts. It's not like health savings accounts where you're putting money in the employee's account and it's gone forever
Nope.
until the employee uses it. So it's a very flexible tool for business owners. Most of them don't have to set anything aside in a separate account. If they're under 100 employees, there's no separate reporting to the IRS or state authorities or anything like that. So my question for you, Anthony, next question for you, since you're on the front lines, to me, this is pretty self-evident because I've been peripherally in the space for 20 years. And I do the same thing with taxes. I say, here's a better way to structure your affairs to pay less tax. In your case, you're giving clients a better way to structure their employee benefits to pay less for those benefits. How many business owners understand that this is even an option? Or do you have 3 conversations a day with business owners and just blow their mind that you can even do this sort of thing?
Yeah, I would say again, 99.9% of businesses have no idea that this is even a thing because 99.9% of businesses buy it in the traditional manner, that conduit manner. Here's my census broker, go get me rates. That's how they think they have to buy it. I think they also view it as a cost of doing business. So they don't analyze it in a really detailed way of like, why does this cost so much? Are there alternatives? Why has it gone up far outpacing wages, et cetera? So most business owners aren't even aware of it.
Even when inflation goes up 10%,
It still
healthcare,
isn't.
it's double digits every year.
Yeah. And yeah, they don't analyze it like that. So most aren't aware. The ones that I do show, I can't believe that this was an option. I think that unfortunately it creates a lot of internal conflict, a lot of these owner broker relationships.
You're being very diplomatic when you say causes a lot of internal conflict. Let's put that in plain English for us.
Yeah, the owner who, that would have been their money otherwise, the business ran. They're not happy when they find out they've been doing it this way for 10, 15, 20 years when they could have been doing it a different way that could have saved them a ton of money, provided the employees better benefits, maintained a network. They either get pissed at the broker or they get mad at their internal team, CFO, HR, et cetera. And I think that's a big problem too. Is I understand it's really difficult to run a business. I'm sure you're dealing with a million things, but as an owner, if you just pass this off to, say, HR, that's the most common department that handles benefits, it's not going to be analyzed in a cost-effective way. Like they're just trying to maintain the status quo, keep the employees happy, and they're not constructively asking the questions that are needed to figure out how to get a better outcome. It's just cost of doing business, renew. And from what I've seen, owners need to be way more hands-on with this than they think.
Anthony,
We've heard this before.
No, I've heard this, so I'm wondering
in the tax context, because I sit down with a business owner and show them how to cut their tax bill by 40 or 50%. They get really upset. They think, oh, I've been doing this for the last 10 years. I could have had a boat. I could have had a lake house. I could have paid for my kids' college education with what I've wasted on taxes that I don't need to pay. But people they hear the word tax and they delegate it to their tax professional, and they don't investigate it independently. So the parallels between what I do as a tax planner and what Anthony does as a benefits planner, they are so evident to me. They're so obvious. We're finding a different way to do things, a different way that puts more money in your pocket, whether it's saving money on taxes or saving money on benefits. And as we've seen in this episode, it all comes down to the way the tax code was written back in the 1940s.
And so, Anthony, this is a question I'm asking because I've gotten educated a lot on this, Ed, already. Just because, again, I work with ClaimLinx and I learned so much. But why don't more people say, I'm going to take this? When Ed gets to talk to people about this, if you ask him, can I eliminate or reduce your taxes? I'm in. Let's do it. Why is it a little bit more difficult for healthcare?
There's more hands in the pot. Employees, HR, different departments, brokers, there's just more hands in the pot. That's why, as of late, honestly, the costs are so ridiculous that a lot are coming to see the light, for lack of a better term. And we're having a lot of groups switch to this method, which is definitely encouraging. I think something has shifted. I don't know if it was what was going on in Congress with the shutdown or the ACA subsidies going away, but it seems like it's been more top of mind as of late. And that shows into how many groups we've had enrolling into this method as of late. But I just think it's inertia. Owners are dealing with a million things. If their HR department starts saying, hey, I don't want to change this, or I don't want to deal with this, or they perceive it as an administrative burden, or the employee starts asking questions, or agents start doing scare tactics, you can name it. It's been done. I just think that there's a lot of different hands in the pot. And that's why I think it's really beneficial for small employers in particular, where you have a man or a woman who runs the company. Their word is the final word. Once they see something that makes sense and is beneficial to the company and to the employees, they say we're doing it, they move forward and it gets implemented. Those are the kind of groups that, this is really the most helpful for, because it's not going to cause all this debate and conflict in committees. Sure. And it never works out when there's 20 people that have to make a decision.
Having one decision maker is helpful in so many contexts. I can remember years ago working with a school district to implement this policy, and getting through the bureaucracy is tough. If you're talking to a manufacturing company with one owner, that owner can make a decision pretty quickly. I'm in or I'm out. And that owner can tell the head of the HR department, this is what we're going to do. If you're talking to a school department or a school district, they're going to set up a committee to study it. And they're going to be 4 teachers and 2 assistant principals and a lunch lady and a bus driver and a janitor. And any one of those people can say no and veto it, but there is no single person who can say yes. You do have more fingers in the pie in the healthcare arena than you do in taxes, because you've got people who have vested ownership in their own healthcare benefits. That's something that doesn't happen on the tax side. At the manufacturing company, the only person who cares about the tax bill is the owner. The employees don't have a vested stake in seeing the owner pay more or less tax. Also, the way accountants work, accountants don't get commissions based on the size of the tax bill. They don't get paid larger amounts because one client pays more tax than the other. And even in health insurance, the agents, let's talk about this, because agents will fight back and they'll say, no, we're not getting a larger compensation. The compensation is capitated. It's $20 per head per month. That's all we're getting, and we're not getting more when the premium goes up. Talk about the reality behind that defense.
I mean, they could just read the renewal packet. It says it right there. We had 2 weeks ago somebody kind of harbor everything that you just mentioned right there, and we were trying to work with them, because this is a long-standing relationship between the owner and the broker. So we respect that. I don't want to just say, hey, this guy has to leave, he doesn't know what he's doing. Like, I try to say, hey, like, this is the best way to do it. We're happy to put you in the fold and set it up, but we obviously need cooperation if you're going to be the agent. And push back every excuse, scare tactics. And we brought up the compensation model and said it right there. 5% of the premium, they were getting a 30% increase. So it's like, you're getting a 30% raise. You're getting 5% of the premium. You've got that the entire time. That's your agreement with the carrier. Every time you get an increase, you're getting a raise. There's no other way around it.
So even if the premium, even if the commission is per capita, there's still some kind of a bonus or an override or something like that, and those are all straight percentage.
Yeah, exactly. And so, I mean, there's multiple comp models. There's that. There's, if you write X amount of business in a year with a carrier, you hit that threshold, you get a bonus. So even if, they're getting paid whatever, $25 a head, but the premiums are going up and up, to the insurance carrier, that's still a win. They're still hitting that threshold, or approaching that threshold, hitting that threshold, writing more and more business. At the end of the day, it's who's paying you. We get paid by the business based on performance. If they're not saving money, then we're not getting paid. That's the agreement we've chosen to move forward with them. The insurance carrier is paying the broker. The business isn't paying the broker. So who does he work for? He works for the insurance carrier. He could say he has the best interest in mind of the employer, and I'm sure at some level he thinks he does, or she thinks that she does. But at the end of the day, the insurance carrier is the one paying them. They're selling a product. They're not crafting a solution. So I don't think it makes any sense. And if you just translate it to the tax world, it sounds even more crazy. I never even thought of it like that. What if the CPA got paid a higher fee, the higher the tax bill? It's weird. It doesn't make any sense.
It would be like the CPA getting compensated by the IRS.
Yeah, it's oh, you had 50 clients and they paid collectively whatever $10 million in taxes this year. You hit our threshold. Here's a bonus. It's insane.
Yeah.
So
Now,
yeah,
what scare tactics do they do?
and throw legal jargon. Oh, you could be looked at by the Department of X, the Department of Y, but you could be looked at for anything. You could be looked at for your 401k setup. You could be looked at for anything. You could be looked at for the way that your building code is structured. They just resort to these things that are arbitrary fluff that don't really make a lot of sense instead of just saying, hey, is this going to save us money? Is this going to improve the benefits for the employees? And is this in the best interest of the company long term? And instead, they just get into legal jargon or compliance jargon and all these different things. We have tons of businesses who've been doing this for over 20 years, never had an issue whatsoever. We have letters by the DOL, rubber stamping our solution. And you can comment on the 105 piece of it. It's been around forever.
It's been around since World War II. It's literally, it is 80-year-old tax law.
Yeah, they just want to keep the business. They don't want to rock the boat. HR doesn't want to rock the boat. It's not their money that's the problem, and that's why I personally and our company personally loves to work with small employers. They're the ones that are getting squeezed the most, so we can help them the most. Outcome wise, it means the most to them, and it's honestly just less of a headache for us because we don't have to deal with these committees and this group decision making and so on and so forth. We show the right person or the right people the solution, how it works. We get their feedback and we either implement it or we don't. And that's fine. And that's who we prefer to work with. And they get the most help because they're the ones that are getting squeezed the most. These employers that have 10, 20, 30, 40 employees, they're getting killed because the insurance carrier looks at them as a small risk pool. If anybody within that pool is either old, has high cost drugs, or have chronic or acute health conditions, they're killing them on the rates, not only for that person, but for everybody. It balloons it up. So yeah, that's who we like to work with. And we found it to be the best working relationship wise as well.
Okay. How do you guys ever wonder how far premiums really can go? $5,300 monthly premium for a single family. I realize that's an outlier, but that's not sustainable in any kind of economy. Just
No.
you may as well just buy your employees a house. Buy them $1 million
Yeah.
house and make the mortgage payment. That'll be less than the health care here.
That's one thing that Tom said too. He's been saying a lot to different employers and owners and on social media is like, hey, if you're under 50, you don't technically have to provide them health insurance, right? If you don't have to, and it's going to cost you less to buy them a new Jaguar or get them a new condo per month, see if they'd rather have that than the benefits. They get a new car, they get a new condo, and you get to save money. It's insane. It's not sustainable. I don't know what the government, what the health insurance carriers have to do to just control this. I don't know who's making excess profits or whatever the case may be, but it's insanely expensive.
Were you the one recently who told me about the growth of United Healthcare? That some number of years ago they were a $6 billion company and now they're a $30 billion or $60 billion company?
And that's all that we're trying to do. We're trying to be creative. We're trying to help small businesses because at some point they're not going to be able to afford to offer it. And if they're not able to afford to offer it, then they're not going to have employees and their business is going to go under. So I think it's just a matter of time where people are going to have to do things differently. And I think they're starting to understand that based on what we've seen the last 6 to 9 months.
And it's been a longer process than that. You have an intense political debate. You have a framework that Americans think of as how health insurance works, and they think that's Obamacare. And I'll step out on a political limb. I'll say Obamacare made the problem better, but they addressed the wrong problem. Obamacare back in 2008, 2009, we had a certain insurance cost a certain amount, but there was an unacceptably large percentage of Americans who didn't have coverage. So Obamacare came in, and with mandates and some other pieces of law, Obamacare increased the number of people who had insurance. So it took this scarce good and it made it available to more people. What Obamacare didn't focus on nearly as much was making insurance more affordable for everyone. So if the root cause of people not having insurance is insurance costs too much, Obamacare kind of slapped a Band-Aid on the wound by saying we're going to take this too expensive product and we're going to mandate that it be available, and we're going to mandate that if you don't have coverage, you're going to pay a tax penalty, blah, blah, blah. 15 years, 16 years after Obamacare, now we're looking at a health insurance marketplace where it costs more and more. And so you hear people talking about some variation of single payer within the Democratic Party. Medicare for all is a popular rallying cry. Business typically opposes Medicare for all, but business needs to hire employees. And if business wants to hire employees who have an expectation of healthcare and business can't provide that, at some point you think they're gonna have to change their tune, and maybe they're gonna have to support some version of Medicare for all. And at that point, you got different opportunities, different models across the world. Maybe you have a base level of coverage of Medicare for all, and then private employers or private individuals can choose that they want a higher level of coverage. That's not radical. We have that in the United States right now. If you're 68 years old, you're covered by Medicare. And you've got IRMA payments, you've got some form of premium. And if you want more than the basic Medicare coverage, you can go out and you can buy Medicare supplemental. And if you want a private insurance company to administer your Medicare plan, you can get a Medicare Advantage plan. So we have all of those options. To me, it's fascinating as a tax planner because, yeah, we're taking the same mindset that we bring to tax planning, and we're just bringing it to a different system. We're bringing it to how to provide benefits to employees. And both of those are tied up in political debates, and it's hard to see anything breaking in our current political system just because we're so partisan and we're so polarized and both sides are so opposed to each other. But this can't keep going on forever. College costs can't keep going up as fast as they've been going up forever. And over the last 5 years, you have a lot more people who are looking at college and saying, is college really right for everyone? Does everybody need an expensive degree? Maybe a trade program can be better for you. And I know plumbers who went to trade school and started working when they were 20 and built their own plumbing contracting companies. And they've got a higher net worth and a higher income than the brain surgeons who went to school until they were 34 years old.
Yeah.
So it's more than just an immediate discussion of how do I lower my tax costs? How do I lower my employee benefits costs? It's a fascinating whole societal discussion of how far we as an American people let these costs run up. I would think that with a family rate of $5,300 a month, that the peasants would be in the streets with their pitchforks and their torches ready to storm the castle. And Anthony, the reason you're on the show is because I want business owners to know that there is an alternative. You don't have to wait for Congress to act. You can restructure your benefits package in the same way that if you want lower taxes, you don't have to wait for Congress to lower taxes. You just come to a proactive planner like me or so many of the proactive planners that I've hosted on this podcast, and you find someone who can restructure your stuff.
Yeah, it's sitting there for them. They could do it at any time. They don't even have to wait until renewal. It's really as simple as highest deductible plan, maintain the network, maintain the stop loss, use the MERP underneath to give the same or better benefits, self-finance the difference. That's all it is.
All right. Anthony, thanks for being on the show. Really appreciate your time. Let's finish up. Why don't you go ahead and share your contact information so people can reach out directly to you?
Yeah, absolutely. So ClaimLinx.com, CLAIN as in Mark, LIN as in Nick, X.com. Bunch of good information there, articles there. You can follow me on LinkedIn at Anthony McMahon. And then my direct email address, any questions that anybody ever has, feel free to shoot me an email. It's amcmahon@claimlinx.com. More than happy to help and hopefully provide some decent info here on the pod. Thanks for having me on.
Terrific. Thanks.
Ed, great conversation. Definitely check out Ed Lyon and share this podcast. Especially, you're not going to hear anything about taxes and healthcare like this, especially Ed tells it like it is. Appreciate it, guys. That was a special simulcast of the Neil Haley Show and the Lyon Share Podcast, guys. Take care.